Very pleased to have here with me Dr. Hanna, the acting chief economist of Citigroup. Dr. Hanna, you spend a lot of time on emerging markets, basically. And if I were to put my finger on 2 or 3 key drivers that influence the shape of how things will evolve, what would your sense be on issues like the decoupling of emerging markets from the developed market, for example?
Well, I actually wrote an article about, about 2.5 years ago, in which I argued, which was entitled Decoupling Debunked. Because one of the characteristics of this world is that, in fact, nations are more closely knitted together. And so the idea of decoupling in the sense of countries going off on their own, independent of what's going on in the rest of the world, is a silly idea. What is important, however, is that the underlying resilience of emerging markets is much stronger than it used to be in the past, which is not to say that they're not more connected. They are more connected, but there are a number of countries which are better positioned to deal with the consequences of that connection than they were 10 years ago. But that resilience is not uniform. If you think, for example, about countries in Central Europe, they are much more exposed to the kind of declines in capital flows and in trade flows that have hit the world in the last 12 months. Asia, on the other hand, while being very, very connected, because trade is a much bigger proportion of the economies than it was 10 years ago, also has much more robust balance sheets than in 97, 98. Banks are in better shape, households are in better shape, governments, by and large, are in better shape. And that gives those countries the possibility of using their economic tools, policy tools, like interest rates, exchange rates, and fiscal policy, in ways that are counter-cyclical rather than pro-cyclical. And so what ends up looking like is that growth can proceed to some degree independent of growth in mature markets, but that's not because they're decoupled, it's because they're more resilient.
When they're more resilient because they're larger domestic economies, that they actually have a domestic consumption, a domestic demand component to the economy that has built over time?
No, they're more resilient because, in fact, for many countries, the importance of the rest of the world has grown. Yeah? If you look at trade or net trade, so the current account surpluses in many countries are larger, certainly than they were in Asia 10 years ago. Yeah? Well, not 10 years ago now. I should go back to 96 or 97
right.
when you had large deficits.
Right.
Yeah? So you were financing through, the rest of the world was financing you. You're now financing the rest of the world. Your domestic demand, in fact, across much of Asia should in equilibrium be higher, not lower. Yeah? But what's different is that the ability of different parts of the economy to absorb the shocks that come from weaker demand overseas is higher. You have companies in general that are less leveraged, banks in general that are less leveraged. So if you look at loan-to-deposit ratios, they look less stressed than they were. Capitalization in banks is higher. Yeah? And what that means, therefore, is that when the trade flows decline, or when capital flows decline, because you're not reliant on external capital, you can absorb that more easily. Because that slowdown doesn't engender concerns about bankruptcy. Right? That, oh my goodness, the banking system is going to go broke if NPLs rise a few more percentage points. Governments are then capable of, instead of having to raise interest rates to keep capital at home, can actually lower interest rates. Or they can increase government spending, not cut it, because the market isn't going to be concerned that additional spending would be unfinanceable.
Well, the scenario painting is dependent on a number of assumptions. You assume that domestic savings are high, the domestic transmission capability of the financial system is efficient, that the allocation of capital into different things domestically and between countries is efficient, that the trade between countries outside of that coupled environment is significant enough for it to make an impact. You find that in a lot of Asian countries, Taiwan, Philippines, maybe Thailand, are still very highly dependent on one or two major relationships, and and not so dependent on regional trade, for example.
All I was assuming was that the amount of trade that's done in the economy, external international trade, is larger than it was 10 years ago, which is the case.
But is it large enough to make a difference today than it did 10 years ago?
Well, it clearly has, right? I mean, what we had was a financial shock that originated in the United States, that fed through into trade quite quickly, but also fed through into capital flows, and the performance of capital markets, equity markets across Asia tanked last year, right? Did growth tank as much? No, not as much as the equity markets were performing. What was going on there? That was a translation of the withdrawal from risk that originated in the United States that went global. And that had an impact, right, on the performance of the economies throughout the world, and in particular in Asia, independent of what countries you were trading with per se. In fact, if you look at Asian trade in Thailand and Taiwan, in most countries, it's actually more diversified today than it was 10 years ago. So that in principle ought to insulate you. The problem is it doesn't when A, everyone goes into recession, and B, because trade has grown so much faster than GDP, it matters more. 10 years ago, what China exported to the United States was about 3.7% of Chinese GDP. Okay? China's share of exports going to the United States was over 20%. Today, it's less than 18%, but the share of Chinese GDP that is sent to the United States is almost 6%. So the trade share has gone down.
The pie is bigger in that way.
The pie is more diversified. The pie is bigger relative to domestic economic activity.
Right. But how much of that is also dependent on a second engine of demand, which is probably China in that sense? How would you describe the China factor in its relationship with other emerging countries?
Well, certainly the Chinese economy, having grown and gotten more open, matters more for the rest of the world than it has in the past. Though you have to correct the numbers for the fact that there is still a significant portion of Chinese exports for which the value added is relatively small. In other words, there's essentially the re-export portion. Yeah. That matters quite a lot for countries like Taiwan, for Korea, to some degree for Japan, because those are the products where the inputs coming from those countries, also Singapore and Malaysia, are actually inputs into products that are then sold into the rest of the world, principally often into the United States. Whereas countries like Indonesia, Philippines, Thailand, the products that are exported from those countries into China are for generally more commodity-based and for where the final demand is actually in China. So paradoxically, countries for whom the Chinese share in their overall trade is smaller, but the Chinese demand matters more because that is what is driving that trade to a larger extent, say, than the Korean or the Taiwanese exports.
Now, given that scenario, which emerging markets do you see would emerge as new winners?
The countries within Asia, right, that stand to benefit more are those who are more closely linked to Chinese domestic demand, and that tends to be countries in ASEAN. Yeah, with the exception in that argument, I would say, of Singapore and, in principle, Singapore, because it doesn't have commodities to sell. Yeah. Right. But certainly Vietnam, in addition to the countries I mentioned earlier, is a country that benefits from the rise in domestic demand